It depends where we start in these numbers. But on the very first line, in the fourth quarter, it comes in less than the market had expected at 139 million. We penciled in 541. What dropped in the fourth quarter?
Yeah, so hi, Mavis. For the year as a whole, as you say, we were up very strongly, sort of 55, 60%. So coming out of COVID and the more tricky parts of COVID, I think actually performance we're really pleased with. Returns we've got for the year as a whole are actually up at roughly the same level as we had immediately prior to COVID. The fourth quarter was a little bit weaker, less volatility in the market. We took some of the charges just to be careful about the commercial real estate sector in China. But other than that, the momentum in the quarter was strong. Fourth quarter does tend to be weaker as well. It's also worthwhile pointing out. But coming into this year, the start of this year has been strong again. So we're very happy with how last year went and how we're entering this year.
Andy, that preparedness on China, just very briefly before we move on, are you concerned about a material slowdown in China?
No, we're not. The growth we have seen overall in China in our business there has been really strong. We were double-digit growth in total for the year. The commercial real estate sector is just one sector that has been going through a few ups and downs recently, but the overall level of activity in China remains high, and indeed where we've talked about what we're going to be doing over the next 3 years, we are going to be putting focus there.
750 million in a buyback. I had Jefferies, they penciled you in for $1.7 billion. This is going to disappoint many. Why $750 million, and why so far away from this estimate of 1.7 billion?
Well, I think you've picked the highest estimate there was out there in the market. There were estimates ranging from about $500 million to the $1.75 billion. Most of them, I think, were more in the $500 to $750 million range. So anyway, we are doing $750 million now. But importantly, what we've also said is that over the next 3 years, we think in total, including this one, we should be returning in excess of $5 billion, which is about 20% of our market cap. And that's on top of having bought back about 6% of our market cap over the most recent 3 years. So we see the pace picking up.
Look, part of this narrative on this buyback over the next 3 years, is it just that you're struggling to find the right assets? You've passed on the city assets in Asia, in Malaysia, Indonesia, and Thailand. You've passed on those assets. Are you struggling to find a lock-turn asset to buy?
No, that is not the way that I'd look at this. What we have done is said, with the assistance of interest rates, which do seem like they're starting to normalise, we think we can get top-line growth in the 8 to 10% range over the next much higher than we have had in recent years. And off the back of the profitability that generates, we've got enough to both invest in the business, but also to return money to investors. There may be occasional M&A opportunities. We'll look at them. Sometimes they'll happen, sometimes they don't. But we're strongly of the view that the business has got significant organic growth opportunity in the markets we're in, and therefore we'll be able to both grow and do the bigger returns.
Where's the growth going to come from? Because if I look at the social and political landscape in Hong Kong, it is challenged. I am being generous with that word. It is challenged. To that end, are you forced as a business, A, to look outside and build outside Hong Kong as the hedge?
So generally, we have seen customer demand actually being reasonably strong through COVID. Overall balance sheet growth was about 6% during COVID year last year. So we are actually already in parts of the world that are evidentially growing. Our Hong Kong business has been slightly flatter, but that is almost exclusively because of the interest rate effect. The underlying volumes there were 10 to 15%. So there is strong growth underneath it. But we'll be pushing, as I say, in China, in Singapore, and many of the Asian markets. Our results actually for last year show our growth rates were actually pretty similar in Africa and the Middle East as they were to Asia. So I think we're pretty broadly spread, and we can withstand the ups and downs in individual markets at individual points in time.
So rates has been part of the re-rating for your stock. I just wonder, is a rising rate environment enough to radically shake up the stock price? That's what's going through my mind. How many rate hikes are you expecting? Markets at 5. Will we get 5 this year, Andy? What's the risk of 7?
think for us, it's slightly less about the number of the rates rises. It's more about how much of an increase in the rates we expect to see. And what we've said today is that our internal plan is that over the next 3 years, we'll see rates rise about 170 basis points above where they started this year. Actually, the way the market is pricing out at the moment, we are being quite conservative. So the good news that is whether the market's right or whether we're right, we do think the period it will take us to get to the 10% return on capital we've been seeking to do for a while is now shortened, and that we should, the year after next, 2024, actually break through that barrier. And interest rates will be definitely helpful to that. They have been unhelpful to the cause the last couple of years, but those forward forecasts are bringing us more back to pre-COVID levels, at which point we think we should be back at the returns that one would be expecting from our business.
Andy, you've lived through many hiking this cycle, as have I. What's the risk of 50 bips in March? What would it do?
I think we'll see gradual increases generally rather than sort of cliff edge increases. Governments are very wary about smaller, more fragile businesses, and therefore I think they want to be measured on that front, whilst obviously addressing the inflation pressures there are out there. So our view is over the period of time, we'll see a number of smaller increments, and the shocks hopefully therefore being somewhat suppressed.
Andy, I want to circle back to Hong Kong because I think there are many iterations, not least the rate story, the social story. We're seeing stories that Citi are moving a lot of their, I need to be careful, Citi are moving some of their senior equity people out of Hong Kong. Are you actively talking to any of your staff about moving to Singapore or here to Dubai because of perhaps the constraints, the social constraints? Is it getting harder to get senior people to stay in Hong Kong, Andy? And are you in active discussions to move people here or to Singapore?
No, generally we're not. We have got a very big business in Hong Kong. It's a huge part of our overall activity. We have got a very committed sort of workforce. Obviously, there will be one or two people who are expatriates where some of the restrictions recently, have been a little bit more invasive in terms of their sort of personal life. But it is a very perimeter. So the core of it, no, we're very focused on Hong Kong. We're not talking about any exodus away from it. In fact, we do think Hong Kong and the China region are going to be great engines for growth for us over a period of time.
Well, in Hong Kong, strangely enough, HSBC, they're talking about doubling their junior banker bonus pool. You go head-to-head with, you're smiling. Now, you go head-to-head with HSBC. Simple question from the CFO to the CFO. Will you double junior banker bonus pool?
We have not doubled our overall bonus pool, but it has gone up significantly compared with the year before. The year before was low because of the results of the business. But we are.
What is significant?
As we've done previously.
What is significant? Just qualify that.
We are probably a quarter up on where we were last year.
Where's the hottest part of the market for you in retention? Wealth management or the investment bank?
I'd say probably more in the wealth management space. Varies a little bit by market, but that is where we've seen some of the bigger pressures recently.
Okay, this is the tough question. Bill has been in the seat for 7 years. The stock, Andy, is down nearly 50%. You and Bill have promised the market quite often, it's jam tomorrow, strategy tomorrow, acquisition tomorrow. Are rate changes alone, Mr. Halford, enough to justify you and Bill remaining in these positions? Do we need something more radical? Maybe you're ready to sort of put your hat in the ring. Do we need something more radical from you and Bill?
I don't think we do. I think that we have got more confidence now that we are only 2 years out from getting the return levels than we have been for a long period of time. I think history will show that over the last 2 years, very low interest rates have made it very difficult to get the returns we want. We've said today that we've probably lost about $2 billion from our top line and our bottom line over the last 2 years. Rates now projected to revert back to where they were pre-COVID. That should put another $2 billion on our bottom line. And off a bottom line, it's about $4 billion. A 2 increase is proportionately huge. do think that with the interest rate improvements that are now well factored in by the market, we will see this business back at the levels that Bill and I have been seeking to achieve, and our management team, over the last several years. And I do think in another year or so's time, we'll be sitting and saying, actually, this business is really firing all cylinders. We're back to a normalised interest rate environment, a return to what we wanted. Hopefully, the share price will have reacted in response to that as well. So I just think we just need to be thoughtful. It's a particular phase. It's been a particularly difficult phase, but we are very, very well set as we look forward.